Assalamu alaikum. Today we are going to discuss a very important topic, that is financial statement analysis. As a banker or as a credit analyst, it is important to examine and to understand the credit worthiness of the borrowers. There are many ways and many tools we apply to verify, justify the credit worthiness of the borrower. But in terms of financial statement analysis, we get the numerical value, mathematical value, or prediction of a borrower, whether the borrower can pay its loan installment in due time. And we also justify and evaluate the financial strength of the borrower through financial statement analysis. To let me begin with by there are four elements of financial statements broadly, that is income statement, the second is cash flow statement, third is owner's equity statement, and the fourth is balance sheet statement. So each of the statements are carries a very significant meaning for a various stakeholders. Suppose if I am a supplier, I am really interested to see in the cash flow statement so that the party can pay my goods or services in due time. So whether the business entity is capable of paying the business due in due time through its cash generation or revenue generation. So cash flow statement is very important, not for suppliers or creditors, also for bankers. We the bankers as a creditors, we want to know the smooth repayment capacity of the borrower without liquidation of mortgage or other securities. So it is a primordial and primary duty of a banker to properly justify the capacity of the borrower to pay its short-term obligations and long-term obligations through smooth revenue generation activities from the business. So cash flow, if we look at the if we look carefully, the cash flow statements generally we got three parts, that is cash flow, cash inflow and outflow from operational activities, and that is cost of goods sold minus the in total if we deduct the total sales or revenue of if we deduct cost of goods sold from total cost if we deduct cost of goods sold from total revenue or sales, and we also deduct the various expenses like expenses for administrative expense like salaries, and also the cash payment for taxes, cash payment for suppliers, cash payment for the various activities. And there are many expenses, rent and utility expense, and we have seen there might be a salaries and wages, and we also the raw materials expenses. If it's a manufacturing and manufacturing entity, that means labor cost is very important, variable cost is very important. If it is if it's service industry, the salary is a primary cost, and selling expense, marketing expense, advertisement expense. So there are various expense for a period of time. We generally calculate of a particular period, generally 1 year, and we deduct all the incomes and revenues, we deduct all the expenses from the revenues, and at the end of the period, we at the end of the year we calculate the cash of the beginning year minus plus cash inflows minus cash outflows, and we got the year-end cash flow balance. So through cash flow analysis, the important thing as a banker, we can detect the fund inflows and outflows. It is very important because if we see that the revenue are generating from selling of products and services, that's a good sign. But if cash is in flow by selling of equipment, plants, lands, this is not a good sign. Even if the cash flow is high by selling equity, by selling plant properties, land, buildings, so fixed assets, this is not a good sign for a business. And the second thing is cash flow from investing activities. It is very important. Cash flow from investing activities is very important because business invest in very for purchasing of equipment, purchasing of raw materials, and they are also sometimes cash generate from selling of long term investment in land, properties, business. If the buyer, if the borrower has a huge amount of land assets and also equipment, machineries, and if he sells some land or some piece of land and generate cash flow for this is not a bad thing sometimes. But we can get the if suppose sometimes cash flow showing negative because suppose borrower is investing and purchasing huge amount of capital machineries, capital for purchase of long term machine, high value machines or equipments, and that is not a good bad sign, because investing in capital such as machineries, equipments, lands, buildings, it creates long term value, fixed asset value, and that's a good sign for business, because because it has the capacity to generate revenue in future. So investing activities is very important. So through cash flow analysis from in perspective of investing activities is very important. If business invest in long term investment, such as machinery, equipment, land, building, expansions of high rise building, and this is a good sign. And if we see that the business is selling its lands, properties, equipment, machinery, sometimes it's a signal that and there is something is going on to and that might result in shutdown of the business or entity. So investing in this kind of business is risky. And the third one is the financing activities. So suppose investment in capital market, bond market, and or these are the also we can see from cash flow analysis. So and another important analysis of the business is that is balance sheet. So balance sheet is very important. We can get the clear idea about the assets positions, liabilities positions, and equities positions through balance sheet. So balance sheet is sometimes it is very important for understanding the comprehensive idea about the organizations or business entities financial strength. Suppose the how much the equator in how much equity of the proprietor has in the business. So balance sheet is very important because through balance sheet analysis there are various tools for analyzing balance sheet, that is horizontal analysis, vertical analysis, ratio analysis. Suppose if we compare the balance sheet of 2015, 2016 and 2017, 3 or 4 years, you can understand through horizontal analysis and through the trends of the assets positions, liabilities positions, income positions. So if we see the gradual growth of the business, the trend of the business, and that will help us understand the business, whether it is a growing concern or a declining concern. If it is a declining, why the concern is declining. And another important statement, that is balance sheet, not income statement. So ultimately it is the revenue or income that will help us to understand the business real positions, because without profit, without revenue, no one going to invest and no one going to finance you, if unless and until the organization, the property has enough revenue. So there are different different tools and mechanisms to discuss the income statement. So income statement is particularly, it's a periodic statement, generally 1 year. We see that it is in simple terms, total cost, total revenue, if we deduct total expense, both in operating and non-administrative expense, advertising, everything, if we deduct all kinds of expense from its revenue, and revenue can be generated from cost by selling products and services, and also by adding its interest earning from banks and other share or debenture earnings. So if we deduct all the revenue, all the expenses from all from the revenue side, then we get the net income of a period of time, generally 1 year. So income statement is very important, because if we analyze the, suppose if a company over the last 1 or 2 years is average income is what 2 crore per year, so we can if we lend them, suppose somewhere between 1 or 2 crore or 5 crore, and they can we can justify the, can they pay the my loan installment, can they pay back my money. So we testify to evaluate through the income statements whether the proprietor or the business entity has the capacity to pay back the investors money, lenders money, banks money through its income, through directly from the source of income of the organizations or the business entity. So income statement is very important to justify. So and the stars, and another important statement is owner's equity statement. So it is very important for in terms of risk perspectives. Risk means we sometimes we see some fabricated balance sheets, some and owners equity statements. If we look at the carefully the movement of owners equity over a particular period of time, if there is a strong investment, own a strong equity in the business, and that means the business is sustainable. The owner has the attachment with the business, deep stakes in the business. It means business is viable. It is a less risky. But if the owner's equity is less, it means there is something else. The business may be close in some time, because owners has less attraction, less attachment with the business. So equity statement is very important before lending, and before for credit analyst, for a banker, to see how much equity does the owner with the business. And these are the very important tools that elements of a financial statement that I discuss. And also I'm going to discuss some of the very important tools for financial analysis, that is help us to decide whether we should invest or not in of a business, to a business. There are some tools, that is some ratio analysis, that is debt to total asset ratio. So we examine, and that it measures the lender contribution part into the assets. So suppose we divide total debt by total assets. If the ratio is, say, suppose 60%, it means 40% asset is belongs to the it means 40% means 40% will find is owner's investment. So, and it is a good sign, because and sometimes we have another statement analysis, that is, suppose we can say that there is another very important statement, that is, acid test. The current liabilities, so I don't on to go into details, but there are some ratio analysis, that is liquidity ratio. So current ratio is one of the tools, that is, if we divide current assets with current liabilities, and then we get some results. If it is more than one, so that means current asset is divided by current liabilities, and if it results is more than one, it means the company or the business has the capacity to pay its short-term obligations through its current assets. So that means company is capable of paying its current obligation or liabilities through current assets. That means it's a good company, so you can invest in it, or in other words, it can pay its short-term loans and installments through its short-term assets. So, and another important ratio is quick ratio or acid test. These are also important for us to examine and justify the credit worthiness of the borrower. Another important ratio, that is solvency ratio. Debt to equity ratio. If we divide total debt liability by total equity, we get the clear idea that how much we should lend, how much equity the business owner has in the business. So we should not invest more than the equitor's money, and that would be risky because suppose 100 taka is the equity, and we cannot afford investing in 200 taka. So we should be very cautious about debt to equity ratio, and it gives us some indication that how much money we can invest, how much the borrower can afford in the long term. And there is another important ratio, that is profitability ratio. This is very important for us as an investor, as a credit analyst, that is return on asset, that how much income how much revenue the organization can generate. So we can get the idea through through a ratio that is called profitability ratio, and sub clause is return on investment. If net income is divided by if net income divided by if net income is divided by current liabilities plus long-term liabilities plus owner's equity into 100, we can get return on assets result. Suppose, for example, net income or net sales is divided by current liabilities, long-term liabilities, and owner's equity. So, and if it is higher than the more the percentage is more the good the business is. So and that is a very important tool to analyze the profitability of the business. And the return on investment means net income is divided by average long-term liabilities plus owner's equity. It means this is not a current liabilities. If net sales or net income is divided by long-term liabilities plus owner's equity, we get the return on investment. And another important tool is return on equity. If net income or net sales is divided by number of average owner's equity into 100, we get the return on equity. And earning per share, total earned income available for the shareholder divided by total share, we get the EPS. So another important ratio, that is efficiency ratio or activity ratio. So suppose if through these ratios we can justify, evaluate, and examine the production capacity, the efficiency of the organizations of the business, that how much it can sells in a per year, how much inventory turnover ratio. Suppose inventory turnover ratio is very important, that if we divide total sales by average inventory, we get the idea that of a particular specific period of time, suppose in 1 year, how much in times it can resurface and resell its inventory. So if it is suppose total average total, if we net sales is divided by cost of goods sold divided by average inventory, we get the idea that how much rollover the company can make of its inventory. The more the merrier, that means the more the inventory rolled, and more the company is efficient is. And account receivable turnover ratio is very important. Sometimes we the buyers or the sellers or the a manufacturer sells its products on credit basis. So how many days it requires to get back its receivable, it is a very important tool. It is directly related to cash flow statements. So if the receivable days is shorter, it is a good. If the receivable days is more than 50 days, 60 days, or more than 6 months, it is not a good sign. Because more if that receivable days turnover is a smaller, that means the business is more active and more prospective. If the receivable days is higher, the business is less active. So these are the things that really very important to appears very important to me to discuss. So let me clear, I am not a student of business background, so there are many issues might be and confusing. But if any confusion clarification requires, you can ask me anytime. But yes, I am this is my discussion is based on in the light of what I know. There might be some some errors, and please skip it. And please if anything seems confusing, please Google it and check it, verify it. Thank you.